So at some point, I had to learn to recognize that it's important to be okay with losing control as long as I'm working with people who has established track record and also has established trust with me that I have to work with them in the past. That will actually give me the freedom I was looking for.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of freedom: time, financial, and geography freedom. I'm your host, Micy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now I'm on a mission to help hundreds of thousands of people like me to do the same.
Hi there, welcome to another episode of the American Dream Builder and Investor podcast. I'm your host, Micy Liu. So super excited to be here sharing with you today some of the lessons I've learned as a passive investor, but as active passive investors, look at the deal with a lot more details and get to ask a lot more questions because I'm leveraging a group of investors' money, therefore higher leveraging power, to ask those questions to the sponsors and dive into some of the financials and due diligence documents as well. I know in the previous episodes, we talked about some of the due diligence I usually do to make sure, to my best of abilities, that they're a good investment for me and my investors. While I'm not a financial advisor, not a CPA, et cetera, based on my experiences and my experiences of working with other experienced sponsors, here's a few other things that I learned along the process that I didn't know and others pointed out to me and I was like, waha, or things I learned after we closed on the deal. And luckily it wasn't that big of a game changer, but it could have been if the numbers were big. So here are some of the things, and some of the lessons are from my complete passive investment. Some of them are from my active passive investment, working more as an equity partner to some of the syndication opportunities. So the first thing is understanding GP catch up. It is funny that some people, when they share an opportunity, they don't share with you the complete story. They'll sell you so much on how good the deal is, but they don't really point out to you some of the things they're doing that's different from other people that may not be so good for you. So I invested in a deal. It's one of my first few deals that I invested in passively just by myself. And I didn't realize that there was a GP catch up. So you know how there is a pref return for passive investors? Apparently there was a GP catch up as well, meaning after the passive investors received their return of preferred 8%, rather than it goes straight to split of 70-30, it goes straight to a catch up for the GP for them to receive, for example, a 3% of the returns on their end before it goes to a split. While this may or may not be a huge game changer, the returns may be 1 or 2% difference versus a large amount of difference. But it was just such an important thing to note for the limited partners to be aware. I'm sure they have actually documented hopefully they did document it in the private placement memorandum, being that it was my very first investments. I just trusted the people I was working with and I just signed the documents. So it wasn't a big game changer. It probably won't really change my returns by a huge amount, but it would have been nice to know that I have to wait until the general partners to get certain returns before I can continue to get returns after my pref return. And the second thing that I found to be interesting through my experiences of working with different sponsors as active passive investors and as passive investors is there is really a pro and a con of having your own property management company. So one of the team I worked with, they have a newer property management company they were trying to stand up. I think they stood up a little bit too premature and they were turning the units pretty fast, but they weren't filling the units fast enough because taking a property from low occupancy to a high occupancy takes a lot of operational expertise, very hands-on experiences, not just in marketing, but also hand-holding with the lease managers to make sure things are running properly. So they weren't necessarily doing a bad job, but we definitely had very high expectations walking in there. And being that it was a newer property management company, it just wasn't meeting our expectations. So that was one of the cons. The pros from some of the people I have known, I haven't also worked with, is you can actually get a better cost in terms of you're not really trying to make tons of money with your property management company. Hopefully, they're not trying to make tons of money with that, but they are trying to find ways to really improve the operations because their end goal is to make that investment good. And property management is just a tool for them to do that, to improve the operations, save cost while doing that, versus having two different parties with another party having maybe potentially a conflict of interest. And the tricky part about that is it becomes really difficult when a property management company isn't doing well. This is where you have to have some people you trust at the sponsor team that's willing to say, hey, that's not doing well. We need to change. If it doesn't get better by the state, we need to get a new company. And that's what happened with one of our team's property management company. We had to switch it out to another company that's not ours. And I'm glad that the team I worked with had the courage and also the integrity to make that happen. So the next lesson I wanted to share is about inflated cash flow with invested funds. This is an interesting one. I say it's interesting because a lot of times you don't see this right away unless you're underwriting a deal from scratch.
This podcast is sponsored by Life Mission Capital, founded by me, Micy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
There are so many different types of underwriting templates out there. And sometimes when you look at the numbers, you don't completely catch the fact that the cash flow was inflated from the funds investors invested. What does that mean? So, for example, right now with our interest rate, right, January 2023, interest rate being pretty high, it's really hard for a multifamily deal to be cash flowing 5, 6, or 7% in year one. It's not possible. It's just difficult. And some sponsors, they would overraise rather than needing $1 million to close the deal. As a simple example, they may raise $1.2 million. And they will actually take the extra $0.2 million to help distribute additional cash flow for year one, therefore making their numbers look a lot more higher for cash flow for year one. Well, I'm not sure if there is potential legal concerns around it. I see a lot of people doing it, so there probably is none. I'm not a lawyer. I'm not qualified to speak about it. But it feels a little bit weird when you use my money just to inflate the numbers. It's okay if it inflates a little bit, but it's not okay if it, if like you're saying 7% return is literally like 5%, it's just my money being returned without actually coming from the operations, right? Because I want the cash flow to be actual operations generated returns. Because if I were to take my money to invest and buy a single family home, I'm not going to take my money from my left pocket and put it in my right pocket. I want the money to actually come in from the operations. That's true returns. So that was an interesting one. Since I learned that, I tried to avoid deals that does that. And the next piece is experiences with a lender. We worked on a deal where it took quite a few months to close. It was partially because we never worked with a lender, but another reason was also because the interest rate was changing a lot during the end of Q2 2022. And it was changing so much that the lenders were changing terms on us and we had to look for a new lender. But also, we didn't have experience working with a lender. So that caused us some pain with taking way, way longer for us to close. And I'm so grateful that our investors were patient with us. We got it to a close with a good long term, and that was good. But the experience communicating with investors and some investors investing for the first time, it was just a lot to go through with those first time investors and with the sponsor as well. And the next thing I learned is about the importance of monthly cash flows as a passive investor, seeing money coming in, even if it was just, I don't know, $5, that obviously will never distribute anything, just $5. But even if it's a small amount like that, it's so much better to receive that on a monthly basis versus like 6 months later or 3 months later to receive an amount of, I don't know, 500, $1,000, depending on the amount you're investing in. Just that seeing the money coming earlier gives me a sense that the operations are running correctly, they're running well, and this whole thing is not a scam. Obviously, I never thought it was a scam, but I'm just speaking from a passive investor standpoint, and it's the feeling that others express to me, and I believe it's a good thing to do. So right now, I look for opportunities that has more of a monthly cash flow and monthly update as well. So really keeps the especially first time investors with us engaged on what's happening with the property and the money that invested with us. The next piece is validating the comps. I actually learned this early on, but it's crazy how some of the sponsors that's out there, they would have comps that's so far away. And that's not even the same vintage, we'll be looking at a 2018 property in our area. They may be looking at a 2022 property or in downtown somewhere. So I think it's so important to have a good understanding of the comps and the specific areas, because sometimes when you're looking on the map, they can look so close, but it could be a different neighborhood. So having tools at your disposal and also know people who know that area well. So know that, like for example, in Houston, certain areas you turn around that it's a different neighborhood. You can't just say because it's within like 0.5 miles, so it's going to be a good comp. So you can't assume that you have to understand the different neighborhoods, sub neighborhoods, and especially when you're working with some of the C properties, those can really change based on the streets. So you really want to validate your comps, make sure they're true comps, true Class C comps with similar crime rate, with similar vintage, and similar unit sizes as well. And the last thing I learned as I thought about this is it is okay to lose control. While I did talk about the importance of having monthly cash flows, as our investors, especially some of the seasoned ones, gain more experiences of passive investing, they really don't want to be looking at monthly statements or monthly updates on all their 50 investments all the time. Even though it's nice to have in their inbox, at one point, once they establish their trust with us, they really don't want to be looking at all that on a monthly basis. So at some point, I had to learn to recognize that it's important to be okay with losing control, as long as I'm working with people who has established track record and also has established trust with me that I have to work with them in the past. That will actually give me the freedom I was looking for, give me the freedom and the time to focus on what really matters to me. And that's something I had to learn. So hopefully that helps. I know I wrote down those 7 things. First is to understand sometimes there can be a GP catch up. Make sure you ask about that if you think there may be one. Understand the pros and cons of having in-house property management team. Understand that how the cash flow, especially first year cash flow, can be inflated with investors' funds, and knowing that how to work with lenders that you already have experience with versus new lenders can be a huge value add to the closing and the overall experience of the investors as well. The 5th one is about it's so nice to have monthly cash flow. It makes you feel like, hey, this is not a scam. And the 6th one is about validating your comps and looking at the different factors mentioned and make sure it's a true comp versus just because it's close. And the last thing is, remember, it's okay to lose control. It's okay to be a passive investor. Remember what is important to you for your freedom and impact goals. Sometimes you have to lose some to win some. And the losing control can help you gain so much more clarity in life to focus on what truly matters to you. So yeah, hopefully you enjoy this, my little spiel on the lessons I learned as a passive investor. Thank you and see you soon.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Micy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.